Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Carl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed & Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. Welcome to today's podcast. My name is Nathan Merrill. I am an attorney with the law firm Goodspeed Merrill, and I'm here with Carl Frank of A&I Financial. Carl, welcome to today's podcast.
Hey, Nate, it's good to be here. How are you?
It's really good, and there's just the two of us today. We're going to be talking a little tax, so I guess it was hard to get any of our other compatriots to get excited about that. But you know me, I love talking tax, and today you're pretty much the master of this domain of the things we're going to be addressing today. Do you want to kind of highlight what we got going on to start 2023?
Yeah, it's big, Nate. I can't believe that our friends don't love taxes like you and I. I mean, do they not have any taste? Do they have a social life or something?
Recreation, leisure, all that stuff. This is my...
We'll have to ask Jeff how much fun he's having right now.
Yeah.
Something tells me it is fun. Oh my goodness. Well, at the end of 2022, there were a huge amount of tax law changes that were passed. And the bill itself is 400 pages long. There's over 90 tax law changes.
It's a short one.
Yeah, by your standards. By a lawyer's standards.
Not nearly as sweeping as 2017, but like you said, 90 changes. Some of them are pretty subtle or obscure. So things you might not normally think of as like, oh, government needs to pay some attention to this, that, or the other. So some of these things might just make people scratch their heads and say, why?
I think a lot of them will make, even the one, today we're just going to talk about the big picture, we'll talk about some of the biggest ones that affect the most number of people, but yeah, even these, the bigger ones, you might be scratching your head, but during today's conversation, what a show Congress puts on.
So some of the more meaningful ones, and maybe you can give us a broad stroke overview. It seems like some of the more meaningful changes apply to workers saving for retirement and retirees that are in retirement.
Yeah, exactly. I think about it in three different ways. I mean, there's some that affect only retirees, some that only affect workers, and some that affect everybody. And, we can just dive right in and take a look at some of the biggest changes. I think of the single biggest change as the change to the required age of distribution. So if you have a retirement account, you've got to pull your money out at the age used to be 70 and a half. And that was such a weird age. It was easy to remember, but that hasn't been the case for a couple of years. And now it's even more confusing. So it depends on what year you were born as to when you are forced to pull your money out of a qualified retirement plan. And that includes individual retirement accounts, 401k accounts, 403b accounts, a simple IRA, all types of retirement accounts where you got a tax deduction or you're able to grow it tax-free, like a Roth account. You've got to require, not in the Roth, but in the other accounts, you've got a required minimum distribution age. And so the way I think about it is the 1950s. If you were born prior to 1951, then your required minimum distribution age, the first year you have to begin taking a distribution, is age 72. But if you're born between 1951 and 59, again, the 50s, then your required minimum distribution age is age 73. So you've got another year before the government forces you to pull money out of your retirement accounts. And if you're born after 1960, like you and I, Nate, then ours is all the way up at age 75. So we can defer taxes all the way up to age 75. But if you're born in between 51 and 59, it's 73. And if you're already taking your required minimum distributions, you don't get a year off. You're still going to have age 72.
And the penalties, if you don't comply with this, have changed also, haven't they?
Yeah, it used to be really egregious. If you screwed up and didn't take your required minimum distribution, the government kept 50% of the amount of money that you didn't pull out, and then they charged you income taxes on top of it. Now that penalty has been dropped to 25%, and if you fall within the window, which has yet to be determined, and you try to correct it quickly, then your penalty is only 10%. So it got a little bit more lenient. They push the ages back a little bit. In general, this is good news.
Well, with stuff like this, I always have to ask the question, a little bit off script here, is why?
I love the question, why?
I can't tell if what they're trying to do is bolster the market a little bit by allowing people to leave their money in when they don't need it, because obviously forcing people to take distributions out of their 401ks or IRAs is forcing them to take money out of the market. Maybe they put it back in, but it creates an artificial imperative. But I'm wondering,
yeah,
the
I
other
hadn't thought
flip
about
side
that
of that
one.
is mortality. Just recognizing that some of us that were born later have grown up and presumably live under a more robust health services environment. But given modern day obesity, I'm not sure. I think people who were born before 1950 might actually, at some level, have more durability than people who are growing up these days. But it's just an interesting.
Well, that could be, right? No,
Just
these
an
are deep
interesting
thoughts. I love
question.
it. A couple things. One, it incentivizes you to work later. So,
True.
right? So maybe perhaps they're recognizing that people are already working later, and maybe perhaps they're trying to keep our aging demographics in the workforce a little bit longer. So that,
Well, it goes back to that other podcast, just to plug our other podcast where we're talking about the shrinking workforce and the demographic challenges that we face. Yeah, I mean,
So
maybe
true.
it's actually good policy. I don't know. It's
I
hard to
don't-
say.
I don't know if I could pass any judgment on IRS, either good or bad, or make up any reason why. I do know this. There's one unique thing about it. So even though your age got delayed a year or two or three, the percentage that you have to pull out did not decline. So had you begun your distributions at age 72, if they hadn't changed the rule, by the time you get to age 75, your percentages increase every single year that you're alive. So those of us who get to delay until 75 still have to pull out that higher percentage. So it's really not going to help us out a whole lot. Yeah, right. It just really delayed us 1 or 3 years.
Got it. Well, and the other thing I'll mention, because this does overlap with my area of planning, is, and this was part of the original Secure Act, is that if you inherit one of these IRAs from someone who perhaps has delayed taking it, the stretch provisions, the rollover provisions still apply. Spousal rollovers still are there. So if you're inheriting it as a spouse, you can treat it as your own and wait till you're these ages that we just mentioned and take your minimum distributions or any other benefit. But if you are a non-spouse inheritor of one of these types of accounts, did we get any more clarity on what the take the distributions within 10 years is, or is it still?
That's right. Yeah, that's the bummer. So we used to be able to inherit these things. Spouses can still get their full rollover and not have to worry about it. But any non-spouse inheritor of one of these retirement accounts is only 10 years to pull all their money out. They lost what used to be called the stretch, which was such a great benefit because you could stretch out your IRA over your life expectancy, and then you could pass it on to your grandkids and they could stretch it out. All that's gone. It's a really big loss for the average American. We now have to inheritors have to pull out all the money within 10 years.
Another podcast we could do is talking about how that might be able to still be accomplished using charitable trusts, but that's a different discussion. One of the things I wanted to ask you on this is that 10-year, though, is one of the things they left a little ambiguity around in 2020 when this first came through was whether that's pro rata over 10 years or if you could just take one lump sum at the end of 10 years. Did they decide to add more clarity to that?
They did. You can do it all one lump sum. You have to have it all done in 10 years though. So you can do it pro rata, you can do a 5-year thing, you can do it a 3-year thing, but you have to have it all out within 10 years. So you can wait till the 10th year and do it all lump sum, or you can do it any time before that.
And the strategy there is obviously if you can let it grow tax free and then take it all out at once. I don't know. We'll let Carl do the math. Go see Carl.
Well, here's a great, thank you. I appreciate it. Well, and here's a great idea too. And that's a qualified charitable distribution from that IRA. So, you are allowed to do your qualified charitable distribution from an IRA and send it to a charity and not pay any taxes on it. Your charity, if they're tax-free, tax-exempt 501c3 organization, they don't have to pay taxes either. So it's pretty nice. And you can do that up to $100,000. So that's pretty cool. And so that would be something that somebody could do to spend down that inherited IRA if they wanted to. The QCDs are a little strange though, because they didn't change the QCD age. So you cannot do a QCD if you are younger than age 70 and a half. So there's something weird.
So for all you 70 and a quarter year olds,
you're out of luck.
You got to wait a little bit. Is this provision related to split interest? Is that new?
That is a new thing. So that gets more complicated, but this falls right into your complication level, Nate. You can put up to 50 grand into a split interest entity like a charitable remainder unit trust or a CRT, an annuity trust of some sort, or a charitable gift annuity. So these are all exciting advanced planning things. Now it's only $50,000 though. So, for the amount of complexity, it might not be worth it, but it's definitely something to learn about because that's giving yourself a lot more choice and control over where that money goes. Where in the past it had to go directly to the charity. Here you've got an entity that gives you a little more control afterwards.
Well, my understanding of some of these charitable gift annuities is they tend to be sponsored by organizations. So if you have an organization that has an annuity-based gifting program, might be something worth looking at.
Yeah, it's a great opportunity for people. I think they should learn more about it. And if they're interested in a CRT, then, this is something that they couldn't used to do before, but now they can.
So I'm going to move on to something that, was one of the first financial tools I ever was exposed to was as I was graduating high school, I believe was about the time this was coming into being, the Roth. Is the Roth still at many levels the preferred retirement vehicle if it's available?
Love the Roth. It's a great retirement vehicle. You go tax-free. So you contribute money after tax. It grows tax-free. You don't have a required distribution from a Roth IRA. You don't have that RMD that we just talked about. It's a wonderful vehicle. And then when you die, it passes to your kids tax-free. So that's pretty cool. You did lose the stretch a few years ago, right? The kid does have to pull.
But it all comes out tax-free.
But it all comes out tax-free. So you got 10 years that you can defer it tax-free, and then they can pull the lump sum, but there's no tax burden when they do. The cool thing about the Roth this year, and this is something that you can ask the why question about. So, ponder for a few minutes while I pontificate about why, because I have no idea why, Nate, but that you now could do the Roth in a lot of different ways. You can do it before it was only the Roth IRA, the Roth 401k. Now you've got both of those, and you can do it in what's called a SEP IRA for self-employed people. They might have heard of the SEP IRA, a simple IRA, which is not nearly as popular as anything else I've just mentioned, but some people on the call may have a simple. You can do it in a 403B, which you couldn't used to do, perhaps maybe before. The Roth 403B is now widespread. It's now allowed, which is great for charities. And a Roth 457B, which is it's a government retirement plan. There's now a Roth. So that's good. Roth everywhere. So that's exciting. The other weird thing about the Roth, and this is a real why, Nate, and we can only speculate as to why, that if you're a highly compensated person, and highly compensated according to this tax law means you make $145,000 or more, then your catch-up contribution, and the catch-up is the amount that us 50-year-olds and older are allowed to put into our 401ks every year.
It's like 7,500.
Yeah, right. That has to go into Roth now. So that's weird, right? That's pretty, you used to be until this year that you had to put all of your catch-ups always every single time into a tax-deferred retirement plan. Now they're forcing you to pay taxes today and grow it in a Roth tax.
Well, there's your answer right there. They
and
want
what
the
is
taxes
the
now.
There you go. Imagine that.
Well, and it kind of gets back to, you'll see this a lot. I mean, this is gospel of Nate Merrill. So when you look back to a lot of the tax provisions of 2017 and this one as it's manifest relative to Roths, is politicians are always more willing to give up revenue downstream. They borrow from our kids, I mean, they need the political win now. They need to show the balance, or they need to show how much revenue, I'm doing air quotes here, how much revenue they're raising. If they can give an incentive to get someone tax-free revenue 20 years from now, 30 years from now, they'll do that all the day long, because it's no skin off their back. They're going to be long gone from Congress. They don't have to worry about solving that problem. So that's
exactly answers all the questions. That's why they love the Roth. And it's kind of a cool situation, because over the long haul, it benefits us to be tax-free. And for these short-term Congress people who are only interested for all the reasons you just said in the short term, well, they benefit too. So, sometimes when people tell me, yeah, I don't trust the government for anything, and I don't want to trust them in the Roth 401k or Roth IRA either, maybe you can actually trust their word on that, because it is.
Well, it's the closest thing we get to a tax-free savings account, which is similar to what Mitt Romney was proposing when he was running back in 2012. Just a quick history lesson for everybody. But one of the things he was promoting was basically a savings account that functioned like a Roth, but no restrictions in terms of money going in or out. It was just, it grows tax-free while it's in that account. This is the closest thing we have to that. So anyway.
Hey, man. The Roth is the best way to go tax-free that we know of.
The second best way to go tax-free. No, just kidding. And we have separate. The best way to go tax-free is qualified small business stock. But that's a totally different issue.
Hey, business owners are the best, and you're right. And it may even be better. I mean, if you're a small business owner, I love the QSBS. There is a podcast on that, by the way.
There's a podcast on this next topic too. Education savings. Tell me what are we dealing with there now?
Yeah, 529 plans, commonly known as 529 plans. These are becoming more and more appealing. And a lot of people might look at 529 plans with skepticism, because the rules go basically that you can put money into these things. In Colorado, you get a state income tax deduction for it. So that's pretty cool. There's, 4.5% back on every $100 or $1,000 or dollar that you put into there right away. So that's a pretty good return. And then it grows tax-free. And if you use it for secondary or post-secondary education, then you pull it out tax-free, and you can invest it all along the way. So, but you have to use it for education. Well, now the rules have changed a little bit, made it a little bit more appealing. So you have, at the end of the term, $35,000 you can pull out and roll it right into your Roth. And that's a very exciting thing. It gives you $35,000 that you can put into an education plan. If you don't use it all for education, you can put it into a Roth. And you can set this up so that let's say your kids decide they're not going to go to college, or there's a little bit of money left over. You can roll that $35,000 into your own Roth IRA. You can roll it into your spouse's Roth IRA. You can roll it into the kids' Roth IRA if you want. You've got a lot of choice and control now in these 529 plans if you don't use all the money. It made the plan a lot more appealing.
Or you could go back to school.
Oh, yeah, right. I mean, I need to go at the golf academy. Our office is now sitting here on this golf course, right? You and I are terrible. We need to go. I think we need a 529 plan to learn how to play.
That sounds good. So what kind of changes are we seeing in terms of employment incentives?
Oh, this is amazing. So relief for workers are really specialized. This is where the special interests just wrote this bill. It's bizarre. And I'm not going to pass judgment on any of them. Like the first one is for military spouses. So, spouses, military people are shipped all around the country. And so the spouses get jobs all around the country. what employers are allowed to do now is forego all of the restrictions that they normally put on their 401k plans if they want for military spouses. So a lot of 401k plans require you to work for a year or require you to work 2,000 hours a year, or maybe 2 years you have to work there. All this, you can just check the box and say, nope, my new employee is a military spouse. They might not even be here for 2 years while their military spouse is in the military. So we're going to allow this person, the spouse, to contribute to the 401k plan. So that's nice, right? It's also a complication for employers. We'll talk about that at a later date. Like, oh my gosh, how many complications can I handle in a 401k? Another one that I like that, again, we're not going to pass judgment on any of these, but public safety workers are now allowed to pull money out at age 50. So that's pretty exciting. Now, it used to be that that people who worked and had a government plan could pull out at age 50, but now they're making it so that public safety workers who also work for private companies can do it at age 50. So this is a really interesting development. I know that there's going to be a lot of people who work with public safety workers who are going to take advantage of this. Public safety workers, by the way, include the firefighters, the corrections officers, and air traffic controllers are also included.
Interesting.
I know, right?
I know with the firemen and policemen, I've had several of these people. I mean, they have an extraordinary pension and benefit plan.
They can.
So in 20 years, if you go into the fire department at age, 20, you're retiring at 40. And that probably is why this makes sense, is it's like, you're really going to make that person wait until 59 and a half. They retired 19 years previously. This gives them probably a little earlier access to their retirement, even though they may have that second career, as you point out, because they often do.
I love public safety workers, right? Not going to pass judgment on any of these things, and we'd only be making up the reasons why. I don't know who their lawyers are that got this thing passed, but the special interests wrote a lot of weird things in. Like the next one, get this, Nate, you and I can give our employees $5 discard cards or $20 gift cards. They didn't say how much it could be. Anyway, a low dollar gift card, if we want to incentivize our employees to contribute to their own 401k plans, we just start giving them Starbucks cards and, Panera Bread or whatever.
Bribery.
Bribery. We can bribe them to get into their retirement plans. Weird, huh? That's a weird idea, but that's in there. I don't know. It's good. A couple of things that are really weird, and I'll just go through them really quickly. If you pull your money out early before your full retirement age, whatever that is in the plan or in an IRA, it's age 59 and a half, you have a 10% penalty plus the income tax. Well, now there are exceptions to this rule, and these are really weird exceptions, like if you expect to die within 7 years. If you expect to die within 7 years, you can get your money out of your retirement account regardless of your age. How strange is that? So, right. Yeah. Do you know? Right. I don't know. Right. How do we know? Another one where nobody really knows, but that would be the victim of domestic abuse. So here's a weird exception. You can get up to $10,000 or half of your account value. It applies to retirement plans like 401ks and IRAs both. So if you're a victim of domestic abuse, and there's no definition of this, so I think a lot of people could just claim that they are, and they can get up to $10,000 from their retirement plans. Emergency withdrawals. This is a new weird one that employers, it's a problem for employers, but employees should know that they can get up to $1,000 every 3 years. Now they have to pay it back, and they can use it for any reason, but employers have to be ready to give their employees up to $1,000 regardless of the reason, because the employee claims that they have an emergency. So that's a new wrinkle. And then the final kind of weird one is long-term care. If you have a long-term care expense, you can get up to $2,500 a year from your 401k retirement plan, or 10% of whatever the value is today. So those are some pretty weird, new, odd exceptions to retirement plans that people might be interested in.
Interesting.
So it keeps going. I can keep going. Well, here's a weird one. So you get to contribute a whole lot more. So again, like a lot of these changes are actually really good news. So our contribution limits went way up. Our tax brackets went up last year. The contribution limits that you can put into your 401k plans went up a lot. And in fact, for people who, and this is actually the next one, if you don't mind, it's that we talk about the reverse donut hole. So in Medicare and Medigap, the government talks about donut hole. I don't know if you guys have heard of that before. Well, this is almost the reverse of that. That if you're falling into the donut hole, you might have a cinnamon roll over here, right? It's like the reverse of a donut hole because people only, I don't know what the Cinnabon, I don't know what you call it, but only if you're age 60, 61, 62, or 63. Not if you're 64, right, or 65 or any later age, but if you're these magic ages, who knows why they chose them? Maybe the congressman who wrote these are these ages, who knows? But you
get back to that demographic incentive that you were talking about, keeping people in the workforce.
In the workforce, yeah, they don't want people to retire, so they're giving you 150% of the normal catch-up limit. So if the normal catch-up limit today is $7,500, 150% of that is a little over 11,250. You would be able to contribute that into your plan during the ages of 60, 61, 62, and 63. The other thing that's going on that's really, really weird is that all of these contribution limits are indexed for inflation in units of $100. So they're going up. In other words, you can contribute more and more and more, and they want you to be in the Roth. And for whatever reason, the cinnamon bun folks, when you turn age 60 to 64, you can put in 1.5 times of what you can put in when you're age 59 or 65 or anybody else over the age of 50. Weird, huh?
So what does the magic year of 2025 have to do with this one?
Yeah, so that's the year that this one kicks in. So this rule doesn't take effect until the year 2025, and it's based off of the year 2024. So it's 2 years out. A lot of these rules take place in 2024. This is a rule, like not right now, right? They're a year out that all these rules are taking place, but this one's 2 years out. This rule begins in the year 2025.
So it'd be people age 60 in 2025.
Correct.
Okay.
Or 61 or 62 or 63 or 64, but not 65.
So we can close out with the good news on the standard deduction. You want to?
Yeah, tax brackets went up, which means everybody pays less taxes. And one thing that more and more people are paying today is the standard deduction. Over all these tax rules, even Republican or Democrat, the trend has been less and less categories of tax deductions over the years as the government's trying to raise more revenue in the interim. And so more and more people are just paying the standard tax deduction and not itemizing. And so for those people who are, your standard deduction now for a single person is $13,850 in the year 2023. And married is twice that at $27,700. And if you're head of household, and not very many people are, but it's $20,800.
So just to express this a different way,
yeah,
the deduction basically reduces your income that is subject to taxation.
Yeah,
the
that's
brackets,
right.
When you talk about the brackets going up, what we're talking about are the break points for those rates are triggering at higher values. So whereas just in a hypothetical, if the 20% bracket was at 180, now it's at 190, and you have a standard deduction of 27, it combined, it's like an impact of 37,700 in terms of when you're going to enter that tax bracket. So they kind of work together. The increased deduction lowers your testing dollar amount of income, and the bracket breakpoints increase where you're actually going to hit those higher brackets.
Yeah, it's a good thing. Like, a lot of these tax rules are good news. You'll probably, if your income are exactly the same last year and this year, you'll likely pay less in income taxes this year.
Although with wage inflation for a fair number, it may just be keeping pace with the amount of income you need to make just to get by. So we'll see.
Oh, and food inflation.
That's the cynic in
Holy
me.
cow, right? I mean, you need something. Food is so expensive.
And what's this about 65-year-olds?
Yeah, 65-year-olds get to add another $1,500 onto the standard deduction. So a standard deduction for a 55-year-old is now, a single 65-plus-year-old is now over $15,000 a year. So it's pretty good.
And I think another one that kind of dovetails with this, but wasn't necessarily, it's just a sunsetting of a prior benefit, is the child tax credit and there's a few of these, are actually ratcheting down. So whereas in the giveaway tax incentives of 20 and 21, I think you got close to $3,500 per kid in terms of a tax credit. That's actually tax dollars. Now that's going back down to $2,000 per child.
I believe you're right, and we'll put it in the liner notes to make sure we got the exact right numbers. But yes, as a general rule, it did not get better.
And that, like I said, that wasn't part of this legislation. That's just a combination of old provisions sunsetting. And there's a number of those that start to sunset from the 2017 that combine with this will have, I mean, you talked about 90 changes in this code provision. When you layer in the ones that are expiring under the old one, it's always a challenge to try to keep track of what's going on in the code. So always happy to help people navigate those provisions and those where there's planning opportunities, whether it's on the personal side or the business side.
Well, there you go. We want folks to grow and protect their investments and choose how they want to be taxed. It's part of our mission and passion.
Well, Carl, you rocked it today. This stuff is meaty but important, and I appreciate you kind of with your mastery of all these nuances, especially when it comes to the retirement accounts.
Nate, that was great. Thank you for the compliment. It's so much fun to talk with you, as always.
Well, I think that wraps us up for today's discussion. But don't go too far away. We've got a lot more to talk about when it comes to other tax changes, specifically in the area of retirement planning opportunities. So come back and listen to us again. And in the meantime, make it a beautiful day.
Very beautiful day. Bye-bye.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else and join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.